consumers in the United States will spend roughly $1 trillion on home improvement in 2025. That's a massive total addressable market opportunity, and two of the largest businesses in that industry are Home Depot and Lowe's. So understandably, investors are looking at these two to try and add one of them to their portfolio. In this video, I'll compare Home Depot and Lowe's on critical financial metrics, including revenue growth, cash flow from operations, returns on investor capital, fixed asset turnover, which is important for Home Depot and Lowe's. And then I'll look at valuation. I'll share with you my proprietary discounted cash flow models for Home Depot and Lowe's. And I'll also look at valuation on a forward price to earnings basis to determine which stock is the better buy at current valuations.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starting with revenue growth, I notice one thing right off the bat, and that is how closely correlated Home Depot and Lowe's are in terms of revenue growth. And that makes sense intuitively. They operate in the same industry, although their customer focus is a little bit different. Home Depot focuses a little bit more on the professionals in home improvement, the contractors, and Lowe's focuses a little bit more on the do-it-yourselfers. And so that makes them a little bit different, but for the most part, they're in the same industry. They both capitalize on when people want to spend more money improving their homes, whether they do it themselves or they hire somebody to make those improvements. And looking back in the previous decade, the average revenue growth rate is about 8% for Home Depot and Lowe's, although, of course, the pandemic disrupted things, created a surprising surge in home improvement spending. That was one of the categories that people didn't see coming, but when we look back on it, hindsight is 2020. It makes sense, right? If you're spending most of your time at home and these two home improvement businesses were open during the pandemic, you have a lot more money in your pocket because you're not spending on traveling, you're not spending on going out, then home improvement seems like a logical thing to do. And that's what happened. Spending surged when people were spending more time at home. And then you had the reversal of that trend, which you saw the reversals and the decelerating revenue growth for Home Depot and Lowe's. The recovery has been more profound for Home Depot, which reported 14% revenue growth in the most recent quarter, while Lowe's were still generating year-over-year decreases. When comparing these two on cash flow from operations to sales, Home Depot has had the advantage in almost every trailing 12-month period in the previous decade. So Home Depot demonstrates a better ability to operate its business compared to Lowe's. 12.42% in the most recent period compared to 11.5% to Lowe's. But the bigger thing, the bigger standout is that Home Depot has beat Lowe's in this category so consistently for such a long period of time. And I could have said the same thing about the return on investor capital, except for the most recent period where Lowe's took the lead from Home Depot. Interestingly, Lowe's has consistently increased its return on investor capital. Between 2015 and 2025, it's increased from around 12% to 32%. 32%, by the way, is an excellent ROIC for a brick and mortar business. Might be one of the best I've seen in this category. Home Depot, meanwhile, was doing a great job. That is until the economic reopening in 2022. Its returns on investor capital fell, while Lowe's continued to see increases here. Surprising to see this. This might be a near-term issue that Home Depot will likely reverse, given how it's outperformed Lowe's across all of the important categories for the better part of the previous decade. So this might be an outlier that might reverse. And if I was to make a wager on this, I would say it would reverse for Home Depot recovering its returns on investor capital, returning to levels closer to the mid 30s or approaching 40%. Fixed asset turnover measures how good a company is at generating sales from their fixed assets. These are things like physical brick and mortar locations, stores, warehouses, trucks, planes, etc. These are fixed assets, things that are going to generate revenue for many, many years. Lowe's at 3.916 has been improving significantly, as has Home Depot at 4.6. Again, another metric where Home Depot beats Lowe's in a critical category important to investors. So now let's look at valuation. When measuring on a forward price to earnings basis, Home Depot is trading at 22 compared to Lowe's at 17. Now, I will agree that Home Depot deserves to sell at a premium valuation compared to Lowe's. Whether or not it should be as high as it is right now, that it's close. I wouldn't say it's extreme where it's no, I wouldn't want to pay that premium. And it's also not too low where I would say, well, Home Depot should trade at a more premium valuation. I feel like the spread between the two right now is fair to slightly higher than it should be. When I did my discounted cash flow valuation for Home Depot stock, I found its intrinsic value per share to be $347 compared to the current market price of $365. And given that I like to have a margin of safety with these calculations, I would say Home Depot is fairly valued according to this metric. When I did the similar calculation for Lowe's using my DCF model, I found its intrinsic value per share at $144 compared to the current market price of $234. So in this calculation, Lowe's looks overvalued. So putting it all together, if I had to pick one of these two excellent businesses to buy today, I would lean towards Home Depot over Lowe's as the better home improvement stock to buy at current valuations. Hey everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.